please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Adesh Gupta, CEO of Liberty Shoes, is now joining us to discuss their fourth quarter results. Numbers actually are pretty strong. The volumes are up some 30% this year as we wrap out FY18. Mr. Gupta, first of all, for the quarter, I mean, there is a very sharp drop in finance costs, some 43% drop. Could you start there? I mean, what led to it?
Good morning, Prashant. Thank you very much for inviting me to this channel. Well, what we have done, in the last one full year, in the whole financial year, we are starting to clean up the exercise of, operating profits. And in that respect, what we are trying to do is that how can we maximize our profit? So in exports, what we have done, particularly in areas where we saw that, the margins were very low because of competition. So we have tried to remove those particular lines where it was not beneficial for the company to hit the profit line. So in terms of, the margins which have increased, particularly the interest cost, what we have done, we have changed our model. We have introduced a FOCO model. In a FOCO model, which was franchisee operated, company operated, we have added 30 new stores where we are getting a security level of 6 crore of rupees from the, from the franchisee. As a result of that, the debt which was supposed to be higher, so has reduced further. So as a result, you would see that, the profit margins or the interest cost has, tremendously improved in the company. So the whole exercise is how can we improve the bottom line? That is a major exercise in the last 1 year we have taken.
What about your margins, your operating efficiency this quarter? It's come down close to around 150 basis points to 14.4%. You've ended the year at 15.4%. All of this, I'm assuming, is going to be, after the operating margins of the company on the P&L, the efforts that you're talking about. But for the margins itself, what can you guide us?
See, let me put it this way. In July, the GST was introduced. So in the previous year or in the previous quarter, you would see that the excise revenue or the tax was part of the revenue. But after GST was introduced, we had to remove the element of excise duty from the top line. And accordingly, all the numbers will change dramatically. But if we see our operating profit actually is improved, because we have improved our EBITDA margins also, and also the interest cost has also come down. So if you look at overall of the year, I think you would see that numbers would be far more interesting and more, let's say, better compared to last year. Now the effect of GST, which is going to see from this year onwards, you will see a full year. So there is a combination of GST and excise in the previous quarter or previous years. So that's why there is a lot of differential. But otherwise, our EBITDA margins are improving. And even we see that going forward in the next year, we are focusing entirely on EBITDA margin so that, our EBITDA margin goes higher and higher year after year. And moreover, our EBITDA margin compared to peer group actually is 13% because there is a franchisee fee which we are paying for the acquisition of, brand and manufacturing assets. So otherwise, it's 13 to 14% overall anyway. So the company is at par with the peer group on EBITDA margin, though the net EBITDA is 8 to 9%, but otherwise it is 13 to 14%.
Okay, so all the new stores will be franchisee operated, company owned?
Well, this year we have planned to open about 30 new COCO model stores which are company owned, company operated. And we are also, signing up new stores for FOCO model because there the franchisees have to come forward and add more, let's say, stores. There you can't define numbers because it all depends on the fruition of the franchisee vis-a-vis company.
So, but 30,
as far as company
owned, company operated?
We're going to add 30 more new stores anyway.
Okay.
Correct.
How many did you add
Let me also add to the fact that,
how many did you add in FY18 total?
FY last year we added almost about 18 stores.
Okay, go on. Sorry, you were making a point.
18 means in the COCO model stores. Yeah, what I was trying to say, the company has introduced a very new category of product and brand also, which is called Healers. And Healers is one product which is selling very well in our stores. Last year we sold close to MRP of 10 crores. And this year we expect that the same numbers will go up to 40 crores in Healers category, which is a higher ASP. It's a branded product, it's a technology product, it's an innovation. So I think the company is moving towards higher value products because if we have to improve our bottom line, or even if the numbers of payers may not increase much, but at least the EBITDA margin or the revenue, top revenue and the bottom line improves drastically.
Okay.